this video, I'm going to show you a 5-step blueprint to financial freedom. And if you do this in 2026, you will end up the year for sure with more money than you have started, with better financial freedom, with financial independence, and you will be closer to retirement than now when you are watching a video. If you do what I'm going to show you in this video, you are going to get closer to financial independence, financial freedom, which is what everyone wants, right? And I want to do this video now in January because this is the best time to start your financial planning, your investments, your budgeting for 2026. Okay, so in this video, I'm going to show you 5 steps for you to become a successful investor. This is not a get-rich-quick scheme. We are not talking about meme coins or meme stocks. I want you to be able to, not to be lucky, but to replicate luck year over year over year over the next 10 years and reach financial freedom, financial independence. Not by making one lucky investment, but by being a consistent investor, by being the Warren Buffett of our time. This is what I'm going to show you in this video. And yes, it's possible for you, whatever age you are at the moment, it's possible to retire in less than 10 years. I have retired at the age of 39 and I live in Hong Kong, okay? It's one of the most expensive cities in the world. And when I was 30, I was absolutely broke. I was broke. I didn't have money barely to buy food, okay? I had a business in the past. My business went belly up. I was scammed by my previous business partner. And now I'm retired. And when I say retired, it doesn't mean that I'm chasing a golf ball every day. I'm very busy. What I mean by retired is that I don't have to work. I work because I love it. I love to share knowledge with you guys. I love to share knowledge on the Henrique Wealth Academy, my Wealth Academy. You can check the link in the description. But I do what I love and what I like, and I like to share knowledge. And I reach retirement through consistency, not shortcuts, and I'm going to show you the 5-step blueprint that I have followed to reach financial independence and retire at the age of 39 in one of the most expensive cities in the world, in Hong Kong. Okay, first, generate income, then you need to save money, of course. You need to eliminate debt, especially high interest debt. You need to invest consistently, and I'm going to show you how to invest, and you need to have a long-term mindset. But let's start with generating income, okay? This might be obvious, but for you to save money, you also need to generate more money. You need to generate cash flow at the beginning, right? And how can you increase your income? Well, you need to look around you and see what can you do to make more money, because the more money you make, the more money you will save. I don't want you to make money just to spend. I want you to make money to save. And personally, I have made more money last few years by relocating to a low tax country. I'm originally from Portugal. Portugal, you pay up to 50% personal income tax. Totally sucks. I moved to Hong Kong, where the highest tax bracket is 17%. Okay, so pay way less taxes. The less taxes you pay, the more you can save. You can also get a new job, get a promotion. Every time people switch jobs, usually you get a 8 to 15% increase. That's what the statistics says. So if you try to find a new job, of course, invest in yourself, improve your skills, learn more, take courses, invest in yourself, in your knowledge, and you will be able to get better career, to get promotion and so on. Side hustles are also very important. You can be a content creator. You can provide services, consulting, sell products online. Some of the things that I have done over the last few years to make more money that also allow me to retire earlier. For example, I wrote 4 books. I have a Medium blog where I wrote 450 articles. I created online courses, and all these things together generated passive income that's also helped me to accelerate my retirement. And you can also eventually sell products. I used to go to China with 2 suitcases and buy wireless earphones, Bluetooth earphones, and then I will resell them online, for example. This was a low-risk budget that allowed me to do some additional money. So try to think, what can you do to make more money? Side hustle, drive Uber, do food delivery, teach online, write, do Etsy, whatever. And then once you are doing more money, you can also save more aggressively. Well, you can already start saving aggressively, but the thing about saving is that most financial advisors, the common financial advice is save 10% of the money that you make. That's so wrong, because if you save 10% of what you generate, you will only retire at the age of 65, okay? And you don't want to retire only at the age of 65. I want you to retire in less than 10 years. So if you are now 30 years old, I want you to retire before you are 40 years old, okay? And to do this, it's possible, 100% possible, but you need to save more aggressively. You need to save up to 50%, okay, of whatever money you generate. If you are making $5,000 per month, try to save at least $2,500 every month, okay? And think about delayed gratification. If you want to buy a new pair of sneakers and you have already two pairs of sneakers at home, don't buy them, because whatever money you invest now, if you can save $100, if you invest those $100 at a 10% return, you'll transform those $100 into $200 in only 7 years, okay? The average stock market return over the last 100 years is like around 10%, meaning that if you invest money in the stock market and you just get the average, okay, in my Wealth Academy I show you how to get 2 or 3 times that average of the stock market. But if you just get the average, you will be able to double your money, your savings every 7 years. So before thinking about buying a new mobile phone, buying a new pair of sneakers, you think, okay, these $1,000 that I'm going to spend now on a mobile phone in 7 years could be $2,000, okay? And then this is a snowball. This is going to compound and accelerate your retirement. So you need to have an investor mindset. Instead of having a consumer mindset, a buyer mindset, instead of having a spender mindset, you need to have a, an investor mindset. Instead of buying a pair of Skechers sneakers or Nike sneakers, you need to be the business owner. Buy the Nike stock, okay? Be the owner of the company to benefit from those people who are buying the Nike sneakers. Not you are not buying the Nike sneakers. You are buying the Nike stock and getting dividends over the next 10 years from that Nike stock, and allow it to compound over the years. If you do this, you will do very, very well. I promise. Number three, step three. Eliminate high interest debt. If you have any high interest debt, a car loan, a credit card, sometimes these loans have very high interest, 20% plus, you need to pay off your debt and you need to do it aggressively. High interest debt destroys your wealth. Okay, so if you are paying a credit card that is like 20%, you you are losing 20% a year. Okay, you could, if you pay off that credit card that you are where you have a 20%, 25% interest, is like having a 20% return on your money. So please pay off any high interest debt. Number four. Now this is where the investment comes. Now that you are saving money, you need to invest consistently. And there are three big asset classes where I usually invest. It's index ETFs. This should be the staple of your portfolio. Okay, the number one thing that you can invest in, the safest and the most proven over the long term, is index ETFs. Just S&P 500, Nasdaq ETFs is very simple, very passive, very, very effective. Even Warren Buffett, when people ask him, like regular investors, where should they invest, Warren Buffett just replies, invest in the S&P 500. S&P 500 and index funds such as the VOO or SPY, for example. Then you can also buy stocks. I'll show you how to do this. But you need to find underpriced, undervalued tech companies. And this is where the big money is to be made. Imagine you have invested in NVIDIA 2 years ago or 3 years ago, you'll be doing very, very well. And then you can also allocate a small percentage of your portfolio to crypto. I've been in the crypto space for many, many years, and I still have around 5 to 10% of my portfolio into Bitcoin and some other altcoins. But this needs to be very strategic, and I think the upside in the crypto space is now kind of capped, and we have much more upside. Number one, index ETFs. Number two, stocks. Okay, let's talk about those index ETFs. They are passive, they are simple, they are boring, but they are very, very effective, okay? They index ETFs, just investing in the S&P 500 with VOO or SPY, will allow you to outperform most of Wall Street managers, okay? 80% of Wall Street fund managers lose money or underperform the S&P 500. So by just investing in these ETFs that I show you here, VOO, CSPX, or the Nasdaq QQQ, you will make more money, okay, than Wall Street managers who have like millionaire salaries, Ivy League schools, billion-dollar funds, and you can still make more money by simply investing in passive index ETFs, okay? I personally like CSPX more than VOO because CSPX, instead of paying dividends, it reinvests dividends automatically, allowing you to compound your investments over time. Okay, and then you also have leveraged ETFs. Okay, the leveraged ETFs that you see here, SSO, UPRO, QLD, basically return 2x or 3x whatever the S&P 500 returns, and this compounds your investments even faster. But it's a little bit more complex, and it will bring more volatility to your portfolio. I really like them, but yeah, because they are complex, I have created the first course ever about leverage ETFs, how to use leverage ETFs for retirement, and you can check the link to the course and to my community, the Henrique Wealth Academy, in the description of the video. If you want to know more details about this, I cannot tell you now about leverage ETFs in this video because it's a topic that requires at least 1 or 2 or 3 hours, and this video is supposed to be a bit shorter. Okay, other than ETFs, you should also add to your portfolio individual stocks, okay? And in my portfolio at the moment, I have over 50 different stocks. It's a portfolio that I've been building over the last few years. But let's say you can add one stock every month to your portfolio, and you can invest a little bit in these stocks. And what you want to look for is find stocks of companies with great products, with great management, with growing revenue, growing income, and that at the same time, the price of the stock is not going up as fast as the revenue or the income. So you want to find stocks whose price is kind of depressed when compared to the business reality. You know, like Warren Buffett says in Charlie Munger, price is what you pay, value is what you get. You want to pay a low price for a great value stock. And you do this by looking at the fundamentals, by looking at a company whose revenue and income are growing year over year, quarter over quarter, and the stock price is not growing at the same speed. I love this kind of stocks, and this is how my stock portfolio have been returning 2 times of whatever the S&P 500 is. For example, last year the S&P 500 returned, I don't know, 15, 16%, and my stock portfolio returned like 30 something percent. This is what we want to do. Now, Bitcoin and crypto, yes, you can add a little bit, but you need to be careful with the entry levels. You need to buy kind of cheap, low. Don't FOMO buy. Don't buy when Bitcoin is at all-time highs. Buy when people are depressed. When people don't want Bitcoin, when people hate Bitcoin, when no one is talking about Bitcoin, that's when you want to buy. You don't want to buy when everyone is going crazy about Bitcoin, when everyone is like, buy, 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 everyone, and it's like all-time highs. That's the worst moment to buy, okay? Buy when everyone is depressed and no one cares about Bitcoin. That's the best buy. That's the best buying opportunity, okay? And now we need to talk about the investment strategy that you use here. Okay, let me be very clear. 95% of day traders or short-term traders lose money. 95%, okay? And as I said before, 80% of fund managers, Wall Street fund managers, underperform, okay? Trading is not the solution. Investing is a solution. A trader just buys and sells a stock. And the investor is the long-term owner of a business. And as a long-term owner of the business, you will have that big upside, okay? One of the stocks that best perform in my portfolio is Palantir. But I bought Palantir. I started buying Palantir in 2022 when the market was super depressed. And I bought a dip because I really believe it was a good business. And after holding Palantir for years, now I have 2,500% return, okay? I will never be able to get 2,500 on Palantir by trading, by buying and selling, because a trader like buys now, it goes up 20%, he sells, and that's it. I buy and I hold 1,000, 2,000, 3,000%, okay? So the big moves are in the buy and hold, not the buy and trade, okay? Be very aware of this. You need to be an investor with long-term mindset, okay? And there is a strategy that you can use when it comes to stocks, okay? If you find those very good quality stocks, you can do dollar cost average. Add regularly. So you spot a stock, let's say AMD or Intel or Nvidia, whatever is a stock. I'm not giving you any advice at the moment, but you find a stock that you believe it's underpriced at the moment. You put, let's say, $1,000 or 1% of your wealth. You put it, and let's say the stock is trading sideways over the next 1, 2, 3, 4, 5, 6 months, or even lowers in terms of price, and you can add you DCA, you add a little bit more every month to that stock. Because if a stock was good at $100 per share, it's even better at $80 per share. Okay, if the fundamentals didn't change, if it is still a good company, if it was good at 100, it should be even better at 80. It should be even better at 70, unless something very bad happens to the company, the CEO resigns, there is no one cares about the product. If the fundamentals change, you should stop DCA, okay? But as long as the business is still a good business, keep buying the dip, keep dollar cost averaging, always adding to your investments, okay? Then you need to have long-term time horizons. Warren Buffett says, if you don't plan to hold a stock for 10 years, don't even hold it for 10 minutes, right? And he also said, Warren Buffett said, that the best holding period for a stock is forever, okay? Now, you need to have this very, very long-term mindset, but, okay, if a stock is performing extremely well, maybe you should take profits, okay? We don't want to hold exactly forever. For example, stocks like Palantir. Palantir went up 2,500%. So in the meantime, I sold half of my position. I sold half of my position. I cover my initial cost. I'm very happy. And I will let the rest of my profits just ride the wave. But I took some profit. So if you have a stock that performed extremely well, another stock is very expensive, you can take some profits, or eventually even sell the entirety of your position. Now, let me just tell you that really the long-term mindset is the most important thing. There was a Fidelity study. You know who were the best investors on Fidelity? Fidelity is a big brokerage asset management. The best investors were clients who passed away or that lost their password and never touched their portfolio. So really try to act as an investor that you passed away. You forget that money exists, okay? You invest and forget about it, okay? Don't touch your portfolio. The less you touch, the more you will profit. There is also a study that shows that women are better, usually better investors than men. And why is that? Because women have testosterone and we want to buy and sell. We want to take action. We want to do stuff. And then you end up hurting yourself. Why women are a bit more calm. They just buy and hold. And they end up being more profitable than men. That's an interesting fact, right? Now, a very important disclosure, this blueprint has worked very well for me, but this is only designed for long-term investors. If you have the money only available for 1 or 2 months, if you need to use that money to buy a car, to buy a house, to pay for rent, you cannot do a long-term investment strategy. So it's very important to have a cushion of money, to have an emergency pillow of money of worth 3, 4, 5, 6 months of expenses so that you are more comfortable to be a long-term investor. So in a nutshell, to reach financial discipline, it's all about discipline and long-term, no complex strategies, no day trading, no charts. You can use some charts, of course, but technical analysis is not the main thing here. Main thing is, let's recap, generate income, save aggressively, kill high interest debt, invest consistently, keep investing, accumulate build a big portfolio and hold for the long term. And that's it. And you need to start your journey now. And if you need help, the Henrique Wealth Academy is here for you. You can check the link in the description of the video, and I hope to see you there. All right, that's all for today. I'll see you next time. If you enjoyed this video, give it a like and subscribe, and I'll see you soon.